All right, welcome back, everybody. Road to Retirement podcast. Tony Marlette Jr. in playoff-bound Cleveland, Ohio. Tony Shore out in Minneapolis. Wah, wah, wah.
Yeah, the Twins. Bummer. But go Cleveland, right? I mean, you guys are looking good.
Yeah, and I think it's always, any baseball fan will tell you. I mean, if you get to watch October baseball and your team is participating, it's so cool.
Yeah, it's a lot of fun. It
Yeah.
is. It is. Of course, here in Minnesota, where I'm from, we're not thinking baseball anymore. We're all excited about pro football because, we're
You're
one of
thinking,
only two teams. There's only two undefeated teams in the NFL right now.
Chiefs and Vikings, right?
Right. Chiefs and Vikings.
So,
and the Chiefs have barely snuck by on some of those games.
I've seen a couple of their games.
The Vikings, all except for the last one, we won the first three handily, including against the 49ers. So we played the 49ers and Texans and just clobbered them. So it's not like we've been playing crap teams, that's for sure.
Right. I've seen a few of the Chiefs games there. Maybe we've come to expect too much, but they just don't look like they're dominating the way that they used to.
No, they don't, but they still manage to win the games. I mean,
absolutely.
That's what's crazy. I mean, I think Holmes and a couple other players are carrying that team, on their backs at this point. But we'll see how long they can do that.
Yeah.
But this isn't a sports show, is it, Tony?
No, we're not. We're not auditioning.
Up into sports and the sports ball for our listeners out there. We got to talk about finances. And you told me something before the show, and I almost fell off my chair. You said we're 3/4 of the way through the year. So this is the third quarter already. 2024 is like that and gone, right?
We are in the fourth quarter, and it's crazy. Like you said, we are in the fourth quarter. This year is like on steroids. It's just like flying by.
Right.
And so I thought we would just kind of go over kind of like where we started, where we are now type thing. I think there were some different expectations going into this year than has actually happened, which could be a good thing. It could also mean that, to some degree, the economy and the markets are on borrowed time. So we'll take a look at some of the numbers and some of the data and some of the talking points as far as all that goes. And we have that thing coming up in like 32 days that's gonna it's on everybody's mind. Everybody's been talking about it for the last year. And
pizza party?
Yes, we'll call it the pizza party. Of course, the presidential election.
Wait, there's an election this year?
This is an election year, man. Yeah.
I'm kidding. I haven't heard. My phone hasn't been blowing up with texts. Every time I turn on the TV, I mean, we have, unfortunately, we have hundreds dead from the hurricane and just devastation. There's a war breaking out in the Middle East. All I hear about in the news still is the election, it seems, or it's crazy, at least up here where we're at. I can't believe until after it was over, I hadn't heard much about the hurricane up here. And then all of a sudden, the pictures I'm seeing are just devastating. But yeah, the political election in a presidential election year, people are concerned about what their money's going to do, especially their money in the market, right?
Right. And I thought the big thing coming into this year was, perception is reality in the market. So,
right.
We had a choice of either continuing with the current administration or a new administration, obviously. Now, that's sort of waned, and we're going to have a new president one way or the other. If you think about it, it may not necessarily be a new administration because, Trump has been president before and Harris is part of the current administration. So we may not have a quote unquote new administration at all, but in some way, shape, or form, obviously we'll have a new president. I think these things have been weighing on people. I know these things have been weighing on people for some time because we've been having conversations on this, I think, for probably a year now about what's the election going to do. And I think the short answer is, there's always going to be short-term volatility. These two have vastly different policies and vastly different views and visions of the economy. We're actually going to be doing a webinar on the election and your money next week. So,
wow.
Looking forward to that.
Well,
so,
yeah, you're going to do a webinar on this?
Yeah, on the election and your money. Just going to focus on the economic of both candidates, the economic goals, the economic agenda, what they want to do, what it might mean for everybody too. So it's been a good learning experience for me. Obviously, we're going to keep it as nonpartisan as possible. It should be 100% nonpartisan, really. And all we're going to do is just focus on, hey, look, this is what Trump says. This is what Harris says. This is what their administrations want to do. This is what they've, looked at in the past. So it's just going to be a factual analysis of what they're going to do for your money. We're not going to get into anything that doesn't have to do with the economy, taxes, or money, but it's been a really good experience so far.
Yeah. Well, and I think that's great. And I think if you look at 20 of the last 24 presidential election years, the market has ended up.
Yeah.
So I think people getting emotional about the election may be a little overblown, and they shouldn't let their emotions dictate decisions they make with their finances, right?
Well, absolutely. Yeah. And at the end of our most recent market update that I did on October 1st, that's pretty much what I ended with. Like you stick to your goals, your strategy, your time frame. Your portfolio should back that up, not any other noise or anything that might be perceived to be happening. As far as election years, the market's been up a lot of the election years. It's like 75% over time. The market's been up in 75% of the election years. Now, it also depends on what's going on within those years. It's not like an election year by itself is driving the market up. I think it's just what's going on within that year and what we're coming off of.
Yeah. Yeah. And that makes sense.
Yeah. And so for this year, by and large, I mean, really, it's hard to find a negative spot in the market here. You have the S&P 500 up 21% as of September 30th. And this is with a lousy start to August and a lousy start to September. The market has been flat since July. The S&P 500 has been flat since July, which is hard to believe. And we're still up 21% year to date. The Dow Jones up 14%, and then the NASDAQ's up 19%. Strange thing about the NASDAQ, they were up 10% just in July.
Wow.
And we're up 19% year to date on the NASDAQ. So we have unemployment at 4.2, which I think sounds good, but I'm not a believer in the unemployment being as rosy as it appears.
Yeah, that's true. I think you've got a great point there. So we need to look at the indicators, but I think the key is from everything you're saying, work with a financial professional. Don't try to go it alone, right?
Well, yeah, and I mean, right. Your portfolio should. We're not looking to, base a portfolio on what current GDP is or what the S&P is at. We're not trying to time the market. We're trying to build towards a goal and get you to that goal by using, your circumstances, your strategy, your time frame, all those things to work towards it. It's all part of the process.
Right. Yeah, I think they make a great point there. It is all part of the process. And our listeners out there, I know that people are still concerned, and we'll probably see a little market volatility when we get certain reports. I mean, like, we saw some market volatility because of maybe the dock worker strike, right?
So you got that going on too. Yeah, that's the other thing. You have these everything now becomes a political story. So the dock workers strike.
Yeah.
The Iran-Israel conflict going on. Some of the other things as far as the legal proceedings against Trump, like all these things have been brought to the forefront. Inflation's starting to get towards that goal of 2%. We're just starting to get there now. It's starting to look somewhat normalized, but if you're just looking at it now, like that tells you nothing over the last 4 years. So obviously we've talked quite a bit about inflation and interest rates. So interest rates, that's another thing that became somewhat political when the Fed dropped interest rates last month. They're probably going to do it again, October or November. So that's becoming politicized too. So everything is just getting really put under a big magnifying glass.
We've hit record highs, in the first 3 quarters of the year, the stock market, right? So even though we're having volatility, we can't throw the baby out with the bathwater and panic. We have seen record highs this year, haven't we?
Yeah, we have. Yeah, you're absolutely right. And, we had a lot of volatility last October, last April, this August. After each of those corrections, we'll call them, we set new records in the market. So it's good to see, because that means that stock prices are being driven by earnings and data, which is what they should be driven by, not narratives. So
right.
I think that's a good thing.
Yeah. Oh yeah, it's a really good thing. So the last quarter of the year, we have a lot happening, right?
Absolutely.
In the rest of the year, between now and the end of the year, like you say, we've got the presidential election. We're waiting to see what happens in the Middle East. Will the dock workers strike cause, delays in goods or any shortages? How long will it go on? So there are question marks right now for the rest of the year. But what is your advice to our listeners out there?
Well, you brought up the dock workers and the conflict in the Middle East. I think both of those things could start adding a little bit more inflation. We could be looking at, if we have supply chain issues, that's one thing that contributed to inflation a few years ago. We already have oil prices spiking because of what's going on in Iran. So this could be something that, brings back, has inflation rear its ugly head again. As far as what advice I would give, again, I would never say base your long-term portfolio on short-term events. Work with a financial professional. We have solutions too, where you can take advantage of what's going on in the market as a whole from point A to point B. And, if you did that, say January 1st of 2024, the market would have a really hard time not being positive in 2024 if in October we're already up 21% year to date. So we have solutions too, where we can, kind of take point A to point B, a little snippet of time, and only go for, say, 1 year. But the point is, we always recommend diversification based on your goals, your strategy, your time frame, and having this all put together and work for you as part of a plan. We incorporate everything, as you know, Social Security, your pension, long-term care, insurance, whatever it may be. Stabilize the assets for your designate those assets for stability, growth assets for growth. And we only change that when your goals or your time frame change.
Sure. And so it's good to review where you're at. This is probably a good time of year as we're heading into the fourth quarter to review where you're at with your finances, your investments, your retirement plans, your retirement savings and accounts, those types of things, correct?
Yeah, absolutely. It's always a good idea to have that portfolio review, really good at the end of the year, if nothing else, to see where you're at. And if you're looking at your income too for tax purposes next year, although if you waited till October, it may be a little late, but you can look at doing IRA contributions or Roth IRA contributions. Are you still within those boundaries? What are your taxes going to look like next year? Taxes are still going to be 2017 and after levels in 25. Starting in 26, they're going right back up. So these are all things that we talk about during our annual portfolio reviews.
All right. Well, that's great. Now, when it comes to a third quarter update, we know where we've been the past 3 quarters of 2024, and we're looking at where we might be headed. Nobody has a crystal ball, right? Even you, Tony, right?
Correct.
Yeah. So I think that it is good, though. I mean, you do look at the last 100 years of stock market performance. You look at each individual person's situation and goals, and you can get a pretty good idea of where they need to be at, or a plan that will cover things like, stock market corrections and things like that.
Right. Yeah. Like I said, that's what we allocate those assets that are designed for that. into those categories. It's not to say that, if the market's down, we're going to just shift because the market's down. No, we're going to invest towards your goal. If there's an investment that's not doing what it's supposed to be doing for some fundamental reason, then we make changes in those situations.
Sure.
Number one stock this year in the market is I would have you guess, but I don't even know if I've ever heard of this company.
Oh, it's not NVIDIA?
It's not NVIDIA.
And it's not Apple.
It's not Apple. It's a small AI health-driven app company called GAN DX.
Ah, okay.
And they are
GAN DX. So they're combining healthcare and AI. Surprise, surprise. They're the number one stock, right? I mean, any company that's a leader in those combining those fields is probably doing very well. That's where the focus is going to be at for the future, isn't it?
Yep, 45% year to date.
Yeah, and that's not a stock recommendation.
No,
right?
Not at all.
People need to understand.
A little trivia, right?
Yeah, I just want to make sure our listeners understand that any specific stock advice, we don't give specific investment advice on the show. You don't, Tony,
right?
And I don't, because you need to meet with the person and see their personal situation before recommending. Plus, just because that's a bad way to invest. Hey, what's the top stock?
Right.
Oh, I'm going to buy that. Well, what if it's peaked? I mean, you're buying high then, and when you sell, you might sell low. So the time to buy that stock was probably a year ago, right?
Absolutely. Yeah, absolutely. You make a great point. To time the market like that, you got to be right twice. You got to be right on the way in and right on the way out. And that's just not something a lot of people can do.
No. I mean, that's crazy. Yeah. So, well, that's good to know. It's always fun to see, though, what the top stock is. I remember not long ago, NVIDIA was just on fire, right? I mean, it had a down year and then it just soared. And that's because of its involvement. I mean, NVIDIA is somewhat related to AI. So it's their AI development that really caused that stock to go up, too. And AI is kind of the hot thing right now, isn't it?
Yeah, it is. The Magnificent Seven is actually negative since July, which is kind of surprising.
Wow, really?
Yeah. Yes.
So the 7 stocks that carried us for so long are actually negative since July.
That's right. And the other 493 are positive. So this, if you're looking at a silver lining, I mean, broad market performance is back in fashion, I guess.
Yeah. And I think you'd rather see, even though we've set record highs with both, when the whole market's doing great, or just those 7, we've seen the market hit record highs, but it's much healthier for the stock market that it isn't just 7 companies on the S&P 500 carrying it, that the other, whatever you said, 493 companies that are doing pretty well, or more of the smaller companies, or it's the S&P 500, so it's not like there's super small companies in there, but it's good to have different companies other than the Magnificent Seven, and just those 7 companies carrying the stock market is not great.
Yeah, absolutely. It really it takes a little more risk off the table. Even though you're all in the market with the other companies, you're still a little more diversified. So it's a less risky strategy, if you will.
Yeah. And I found it interesting that Berkshire Hathaway, Warren Buffett, the Oracle of Omaha, I know I read a few articles a few months ago, maybe it was back in July, August, that he was dumping some of the Magnificent Seven, or not dumping, but selling off quite a big portion of some of those. And they have their reasons. You can't model what you do over what Berkshire Hathaway does, because he's operating on a different level than you and I, Tony.
I think a little bit.
You're close. You're closer to that, but I'm not. I'm just saying that's different. But I find that interesting. Now you say since that time, those companies have a negative are in the negative. So.
Yeah. You and I are a little off of Warren, but Warren is still trailing Chris Anselmo. So we got that going for us.
Yeah. You've got the Oracle of Cleveland, Chris Anselmo there. All right. Well, great show today, talking about where the market's been and where it's headed here in the fourth quarter. But Tony, you put together some great information, get us thinking. But really what the purpose of this is to make you realize, hey, don't go it alone. Work with a financial professional, a fiduciary who's going to look out for your best interest, look at your investments, look at your savings, look at where you're at overall with your finances. And if you're retirement planning, looking at what you need for retirement and getting that retirement income strategy in place. I know that's what you guys do over there, including taxes and estate planning. So how can our listeners get a hold of you to set up that no charge, no obligation consultation?
You can look us up online at brooksidetax.com. You can call us 440-886-3550, 440-886-3550. YouTube channel, Facebook page has some pretty good stuff on there too. Of course, you can always come in and schedule an appointment. We've seen a lot more of those lately too.
All right. Well, great show today, Tony, and listeners. That does it for today's episode of The Road to Retirement with our host, Tony Marlette Jr.
Thanks, Tony.